trade. But let's invite our Alpha manager, Aman Chowhan, fund manager at Abakkus Asset Management on the show now. Aman, first, your top 3 takeaways from the earnings season so far for your portfolio companies, and have you made any changes in your portfolio based on what we've seen in Q2?
So broadly, the result season has been in line. I can tell you that as far as banking is concerned, most of the companies have reported in-line numbers. Pharma has been a positive surprise. IT, though the street has been disappointed, for us it's been in line. I can tell you that. Chemicals clearly has disappointed. So that in general would be the, you can say, the earnings season for us on the portfolio level. Not much changes on the portfolio. We continue to like financials. So though the large banks have not performed over the last 12 months, most of the large banks are flattish over this period. We continue to like them. So that is something that we feel can clearly outperform going ahead. So that is where incremental money is gone. And just hoping for a good festive season, a good festive demand. That's what I believe all the companies are also hoping for, and same is for us.
Absolutely. Aman, hi. Season's greetings to you and the entire team at Abakkus. Hope it's a great one for all of you. Let me ask you about the new kid on the block. Not so much from a buy-sell point of view, but just your thoughts. I mean, Honasan, a lot of excitement around this IPO. It's a brand that everybody's very well versed with. But the debate has been really around valuations, because I think they're commanding over 4 times sales or some 70, 75 times forward earnings. Just your thoughts on how the market might look at some of these high-profile, high-growth, but expensive businesses. How would you view them?
So we have a very clear thought process at Abakkus that we don't mind paying a premium for a good company, a good business, but the premium has to be justified. It should be rational premium. So for us, the sweet spot would be a PEG ratio of 1.5. Unless there's something which is very compelling, we'll go beyond that. So this company that 4 times sales, 5 times sales is clearly not fits into our criteria, and we don't have, I don't say any exposure in the portfolio right now. In the near future also, I'm doubtful that we will be looking at these names. So these are good businesses, but not at the prices at which they are commanding right now. And that's not what our philosophy is of being a value-conscious investor. So for us, it's a pass, most of these names.
Okay, so that's Honasan and expensive, names in general. Broadly speaking, what have you made of consumers, and would you look at adding anything? I mean, consumer is not a loved sector in the market right now. Earnings have been pretty pedestrian. I mean, volume growth is missing in most places. It's all about a good margin pull, which companies have demonstrated. Your thoughts?
So clearly there is a slowdown at the rural level, at the bottom of the pyramid level, because the inflation has hit them the maximum. And that is what we clearly see, that the urban companies or the urban focused companies still have a decent volume growth, while as the small town or the rural focused companies have seen a demand slowdown coming in. We have not taken any aggressive bets for these companies in the hope that things will recover. As I mentioned, just waiting for the festive season. If we see very clear trends that the demand has recovered and the companies are able to report decent volume numbers, we will be looking at these names. So for now, knowingly focused towards the urban-centric consumer names into the portfolio.
Okay, urban-centric consumer names. We were just discussing Trent. Aman, would you have a view on that?
We don't discuss stock specific. All I can tell you is that it doesn't fit our valuation criteria. It's a good company, great business, but too expensive.
All right. Well, we're not discussing stocks then. Your thoughts in terms of, the outperformance for the broader markets. The mid-cap index is back to a gain of around 27%. We have the BSE small cap index, which is up around 31% Are we good for more as the year closes in?
I think so. There can be a near-term hiccup based on the state election outcome, which is due end of this month. Bearing that, I think we are due for better times ahead because the economy is doing well. Though the global demand has slowed down, Indian companies, India as a country has gained market share versus China, versus many other regions, and that is showing in our numbers. So till the time growth is sustained, I think liquidity, both domestic as well as foreign money, will continue to see India as an attractive destination for investments. That money will continue to flow in. That will keep the sentiments positive and should reflect into the equity market return. So we are pretty positive on the markets from a one-year perspective. And then we have the central elections here, where obviously we all are looking for a favorable outcome.
Okay. What about PSU Banks? I know you hold State Bank of India, but or at least you did in the past. But what have you made of the PSU banking numbers? Because there was a lot of euphoria going into over the last 6 months when it comes to PSU banks. But numbers from, say, a Bank of Baroda have not enthused the market.
So overall, the theme for PSU banks is that most of the banks have been focused on retail lending. Capex as a cycle has just started to come up over the last year and a half. And this is the space where PSU banks are more active. And because of this, they have seen the credit growth picking up. And they were all trading sub 0.5 book, 0.6 time book. And that 0.4, 0.5 has become 0.6, 0.7 for many of these companies. And that's the returns investors have already made on PSU banks. Going ahead, we feel it's better to be selective from the PSU banking space. We prefer the larger PSU banks than the smaller or the mid-sized PSU banks. And that's where our focus as well as exposure is.
Anything other than HCL Tech, which is there as a part of your tech exposure?
Not on the large cap space. In the mid cap space, yeah, we have a few names in the tech exposure. These are the names that we have been holding for the last 2-3 years now and continue to own them.
Okay. Just, a little more on financials. Aman, again, the lackluster stock performance from a banking perspective, that continues. And we've actually seen some NBFCs put out pretty decent numbers. Today's, of course, is Repco. By the way, the Repco stock, I was just looking at it, is up 6-7%. Fantastic growth in terms of the book itself. NIMs have actually expanded in this environment. What else would you look to add, if anything at all, in financials, Aman?
Non-financial based companies. We just discussed BSE sometime back. The stock has hit a new high. Wealth management companies, broking companies. This is the space that is also looking good. So non-fund based financial as a space is something that we are pretty positive on. So besides bank and NBFC, this is an attractive space one should look at.
And how do you find the valuations, considering, just going by BSE's share price run, it's been quite, quite the mover. So overall, non-lending financials, how are valuations here?
They are fair. So they're trading anywhere between 1 to 2 times book, and they earn decent ROE and ROA, plus a good 20 to 30% growth. Till the time markets are doing well, these companies are the direct beneficiary of the buoyancy in the markets also. So it's a decent growth sector, and hence the valuations are, I can say normal valuations. It's not something that they're too expensive that one needs to be worried about. Yeah, they are definitely not cheap at 1.5 times book for a company which is growing at 20% CAGR, 20-25% CAGR, which doesn't need capital to grow. It's a decent valuation to look at.
Okay. All right. Aman, just before we let you go, there's been some amount of a comeback in a couple of these diagnostic companies. The commentary has been better from the managements. The competition is lesser, it seems, from the online aggregators. Would it be a time to probably accumulate these stocks, say, for a longer term perspective?
If somebody has a 3 to 4 year perspective, then yeah, it makes sense to relook at these names. They have corrected from the highs, and from the 70-80 multiples they used to trade, they're now around 20, 25, 30 P multiples. So it's a high growth sector. It's a sector where there is a clear shift from unorganized to organized. So these companies are the natural beneficiary of that. So from that perspective, yeah, but with a 3 to 4 year view, I think one can start looking at this segment also.
Aman, thank you very much for joining in, and happy Diwali to you, your family, and everyone at Abakkus too. I look forward to chatting with you soon. Get into a break. On the other side, as always, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also get you a few BTST calls from our technical experts.